Hey everybody, it's Todd Seymour with Let's Talk Money, and today we're going to talk on investing basics. So, like everything else, I just try to give you an overview, and I don't want to hurt your head at all, but the more knowledge you have in money, the more comfortable you're going to feel about money. And I say it all the time that nobody ever teaches us about money. The only thing people ever teach us about money is you need to save money. Um, but they don't say how you save it and what you should save it in. And so today I just want to talk a little bit about some things that I can give you advice on. And I think it'll make you feel more comfortable and hopefully maybe make you ask a little bit more questions too. So let's talk about the three basic ways of investing, just a little bit of an overview. And when I say basic, I don't mean that they're easy to understand by any means, but I think by the end of the video, you'll have a little bit more knowledge. So first thing is stock or equities. Everybody knows for the most part what stock is, but what most people don't understand is that you have ownership in that individual stock. And so today I'm going to pick Amazon. It's such an easy, relatable stock that we can all agree is a good stock, and it's amazing how many deliveries I get at my house. I feel like it's Christmas every day at my house. And so to counter all the buying in my house, I just bought Amazon. And that way, every time my wife orders things, then at least I'm making money somehow, some way. At least that's my rationale. So think about, okay, I own a piece of Amazon. So when Amazon does well, it's going to grow in value. And that's one of the reasons why I'm buying that stock. Many growth stocks don't necessarily pay income. So, you buy other types of stocks or investments for income that's going to pay dividends. And a lot of us that don't need the income from dividends today, you can reinvest it and it just keeps buying more shares and it keeps growing. And that's the cool thing about stock is that think about anything that you use or you go to eat or you go to Starbucks, you can own pieces of those companies. It's so awesome. Man, I love this pair of shoes. I can buy that company that makes that shoes. Or my wife, oh, I love this purse company or makeup company. Well, you can own a piece of that company that you use. I love to shop at Target or Walmart or whatever store that it is. Or I invest on, I buy online. It's so awesome to think about you can own a piece of that. And so the easiest sometimes way to own stock is just to buy them individually. But what if we're talking about an Amazon? And so I'm going to use, again, Amazon is that's my stock piece. But what happens if Amazon is out of my price range? It's $2,300 a share roughly today. And I have $2,000 to invest. So there's no way I can buy one share of Amazon. But what if I can show you a way that you could still own Amazon just in a different way? And so I tell people all the time, investing does not take a lot of money. And I think that's the biggest misconception about investing is that you think you have to have thousands of dollars to invest. And that's just not the case. These two vehicles, so exchange traded funds, ETFs, you always hear. My business, for some reason, we're lazy and we use acronyms all the time. So ETFs, exchange traded funds, and mutual funds are a good alternative to own stock. They just do it differently. So let's think of everything to me is easier to look at as a picture. So let's think of both a mutual fund and a ETF as a big bubble. And inside this bubble are tons of stocks and bonds and cash even. And there's lots of it. I mean, there's sometimes inside these mutual funds, and I'm just writing mutual funds or ETFs, there's tons of activity going on inside of that. The biggest difference between an ETF and a mutual fund is that, so an ETF is what's called passive investing. And that means that nobody's looking at that. You're basically picking a sector, and sector is like, oh, I'm picking technology, or I'm picking oil, or I'm picking consumer discretionary, or I'm picking utilities. That's a sector. And I just want to invest in that sector, and that's an ETF. And so if that sector does good and goes up, you're going to make money. And if it goes down, you're going to lose money. A mutual fund, on the other hand, is it's active investing. And what that means is on a mutual fund, there's actually a mutual fund manager. And it's usually a team of people that are overseeing this bubble. And they're trading inside this bubble all the time. They're buying and selling and moving money around. And that's why there's higher fees. And, no offense to anybody, but higher fees doesn't necessarily mean that it's worse. It just depends if the fees are fair. And you got to make sure that the fees are not destroying your rate of return. The reason why there's the difference between these two is because personally, ETFs have more risk. And why do I say that? Because ETFs move with the market. So if you have an ETF that's in the S&P 500, let's say, and it's a S&P 500 ETF, it's going to move up and down with dramatic swings like the market does. Every day the market goes up 3%, it's going to do 3%. It goes down 2.5%, it's going to go down 2.5%. Where a mutual fund has all different types of investments in there, even if it's a technology fund or if it's a utility fund, it usually is not 100% invested all the time because that manager is doing trading all the time. And so yes, is there higher fees? Yeah, there is. But the difference between the two is that the mutual funds absorb, sometimes in most cases, I got to be careful, it absorbs more of the volatility. And to be honest with you, whenever you invest, it would be better if you picked all three of these and your portfolio had a mixture of all three of these. So everything shouldn't be in mutual funds and everything shouldn't be in ETFs and everything shouldn't be in stock. When you talk about having a balanced portfolio, it's kind of nice to have pieces of each one because you're keeping fees down because there's no fees in stock because you just own the individual stock. There's a little bit more fees in ETFs and the most fees are in mutual funds. So by having it spread out between the three groups, you're keeping your fees in check, you're keeping your risk in check, you're diversifying yourself, and that's the key. We're going to talk later strictly on mutual funds because they are a little bit more complex because they are active investing. And the one thing that I want to make sure that clients understand is how to know what they're paying in fees, because that's by far the most complicated. I think if you know what you're paying in fees, then it gives you a little bit more comfort. So I'll leave you with this. I put two resources that you yourself as an investor can check on. The first one is a government-run organization called FINRA, and that is who oversees all of us as financial advisors. And believe it or not, you can go on finra.org, and at the very bottom of the webpage, there's something called a fund analyzer, and it will give you can type in the ticker symbol of the fund, and it will give you a breakdown. And the analyzer is a great resource that you can get without having to pay any money. And Morningstar is another fund service that there's two types of services, one that professional investors use, and then also a free service that you can use. But both of them give you such a good overview about what you have. A lot of times if I said, hey, you own a Fidelity ABC fund, what is inside that? Most people would say, yeah, I'm not really sure what's inside it. And these types of things will actually be able to tell you what's inside the funds. So it's kind of neat to see what you own sometimes, and helps if you own two types of funds that have different names, but they have the same type of investing. The biggest thing that we see as professionals is that clients overlap their investments, and so they're really not being diversified. And when the market pulls back like it has recently, you should be able to tell if your fund or if your portfolio is diversified, because if it's pulling and dropping as extreme as the market is, then you're definitely not diversified. And you should look at maybe allocating between the three types of different funds. Those of you that have retirement plans like 401ks, like we talked about before, 403bs, those usually just have these two. And that's fine. You know, many fund companies that offer their 401ks, 403bs, again, it's just a matter of looking at a overview of all the different investments. And the biggest mistake I see clients make is that they'll just print all the history of what the funds have done, and then they go based on that. That's how they'll invest. And you don't want to necessarily just look at what the fund has performed. You want to make sure, again, that you're diversifying inside that, that you're having multiple bubbles inside the big overview of your big bubble. If that makes sense. So hopefully this gave you a little bit of overview of what the differences are between them. To diversify yourself, it's definitely mutual funds or ETFs. To keep things even more diversified and cost effective, it's a mixture of the three if your portfolio allows it. And even worst case, if you just have your 401ks and 403bs, by mixing the two, it allows you to diversify and keep your fund fees in check, which absolutely helps your portfolio return in the long run. So as always, I look forward to feedback, comments. Next videos will start to get a little bit more in depth. I just wanted to give a good overview about where you have the ability to invest in. So the email address that you can reach me at for any questions or comments is taxandtrusthelp@gmail.com. And I hope you have a great day, and thank you so much for paying attention. Bye-bye.